Bullock, two of Canvas Credit Union's best. And we are here to talk about home buying. So if you are not planning to talk about home buying for the next hour and a half, you're not in the right place, but I'm guessing that's none of you. Thank you so much for joining us tonight. We had over 200 people register for this webinar, which I think is just amazing to think about how hot the market is right now. So our goal is to get all of your questions answered. With that though, your mics will remain muted and your videos will remain off, and I will be your voice tonight. So if you don't see the chat, you should look at the bottom of your screen and there should be an option to open the chat. Now is a great time to practice. Open it up. Feel free to introduce yourself if you want to type your name, your grad year if you're a CSU alum, and where you're logging in from. I know we have folks across all 50 states. So feel free to introduce yourself. I would encourage that you send it to all panelists and attendees. But again, would just love to know who all is here and where you're logging in from. I also want to thank Canvas Credit Union, who makes our Young Alumni series possible, as well as our CSU Alumni Association members. So membership really does support all of our programming, and tonight we have everyone from Grad Pack members, so those first year just graduated 2021 grads logging on. Congrats to each of you, all the way up to lifetime members, so those who have chosen to stick with CSU and the Alumni Association for life. Huge thank you to you too. Nancy, I'm going to ask you to go back a slide and talk about a really fun promotion just quickly that the Alumni Association is doing in June. So if you are not a member but would like to be one, now is the time. We are running an awesome promotion, join in June. If you join in June, you pay the normal cost of a CSU Alumni Association membership and you get this nice, lovely beach towel, horsetooth towel, lake towel, depending on where you are. But just a great way to kick off summer. You also get access to exclusive programming, publications, Alumni Association benefits, all of that. If you have any questions, feel free to chat me privately. I'm happy to provide more information. With that though, I know that we are going to have lots of good questions tonight and you all are here to talk about home buying. So I'm going to kick it off to Nancy Patton. Just as a reminder, you are muted, your cameras are off. Please do use the chat for any and all questions. I will be monitoring that tonight. So as your questions come in, I will collect those and ask Nancy and Joel verbally. If you would like your question to be anonymous, we won't share any names of questions, just send it to all panelists. I will see your name, full disclosure, but no one else on the webinar will, and we won't share that when we ask the question. I'd also like to point out that that's the same for all polls. Polls tonight are fully anonymous, so no matter what you answer, I won't know. Peers on this webinar won't know, only you'll know your answer. But they're fun benchmarks just to see where people are falling. So with that, I'm going to go ahead and turn it over to you, Nancy, and I think we have a good night ahead of us.
Excellent. So hello, everyone. Welcome to our home buying seminar. I'm Nancy Patton with Canvas Credit Union. I'll be leading the discussion tonight, but I'm so excited that Joel from our mortgage department is here as well. Occasionally, the people who come to these webinars ask amazing questions that are beyond my knowledge. And so it's so helpful to have somebody who actually is dealing with mortgages every day in the house. So Joel's our resident expert. Alexandra has been doing chat for these forever and is just super, and we have a great working relationship. So send in those chat questions, no problem with voicing your opinion or your question. We love it. As Alexandra said, the polls are anonymous, don't worry about that. And then the Alumni Association sends out information following this webinar. It will include the slide deck and a link to the recording if that is helpful for you. So just automatically as part of our follow-up, you will receive the slides from tonight's class. Okay, and with that, it's poll time. Alexandra, go ahead and give us our first poll. Let's see who is here tonight. So these just a couple questions to get a feel for who's attending our session tonight.
And for those of you who this is your first webinar or you're just joining the Young Alumni series for the first time, you will get to see these results once everyone's voted. We typically give you about a minute. You're at 24 seconds right now. So if you want to get your answer in, you got 30 seconds left. We have about 90% of people voted. I know oftentimes folks are also multitasking with dinner and kiddos and whatnot. So we'll give you about 10 more seconds. 5, 4, 3, 2, 1. Awesome. And we almost have 100% responses tonight too, which
Yeah,
is
so
great.
that's awesome. Thank you for doing that. So the vast majority of attendees tonight are renters. We have some lucky people who pay nothing for their housing, and a few homeowners already. And then more than half of you are from the Metro Denver area, Northern Colorado. Look how many outside of Colorado. So I will comment that, first of all, thank you so much for voting. That really gives us a feel for who's here. Outside of Colorado, the markets vary tremendously, but that's true inside Colorado. Markets vary tremendously. Every community has a unique housing market, and the concepts that we're going to talk about apply everywhere, but our focus will be on Colorado statistics, but you certainly can apply those to wherever you're living. So let's jump into some beginning information. Well, an agenda, because what's a webinar if you don't tell you what we're going to talk about? Let's talk about what we're going to talk about. So we are going to talk about just the concept of buying a home. Some things to consider before you jump into that too far. We will absolutely be putting out there common terms, definitions, things you will hear in the process of home buying and may not have understood before. We're going to try to make sure you understand all the words and acronyms. And if we have people who want to talk about refinancing, we will do that. We had very few homeowners, so I think I have a question coming up about if anybody wants to talk about that later. And then we will be talking about this market we are in and what it means for you if you're interested in home buying. Plus, we always have resources for you to do your homework afterwards. All right, so let's start the discussion with some things that you should be looking at months and months before you are ready to make the purchase. Really, the first decision to consider is, do you even want to be a homeowner? So there absolutely are advantages to owning a home, but there are also responsibilities, and ownership is not right for everyone. So one advantage to renting is being able to make a move easier. Maybe a career opportunity comes up. When you own, you are responsible for repairs and maintenance, or you have to, if you can't do them yourself, you have to pay somebody to do them. So I have colleagues who rent, and while I'm pruning shrubs and mowing the lawn, they're off on weekend adventures. Now, on the other hand, I have a great yard, and my dog and my grandkids can play in the yard. If the water heater goes out, I have to pay for it, and I have to pay for it right now. There's no way I can call a landlord and say there's an issue. But I get to pick my door colors. And if a purple door is my style, then I get to have a purple door, unless my homeowners association has some color palette that I have to adhere to. So ownership is a source of wealth for many Americans. It's also a source of stress for a lot of other people. Please know yourself. What are your abilities financially? What are your abilities with maintenance? Think carefully before jumping into the ownership adventure. But besides the emotional considerations, there are several financial things to consider before you start your search for that perfect house. So there's a lot of talk about, oh, you have to put down 20% of the purchase price. Now, we'll talk in a minute about why people do that, but that is a really big number. For a $350,000 home, it's $70,000. And it is not necessary. Please don't let this 20% down thing scare you. There are many down payment options available. Saving for a down payment is brilliant. It's a great idea, but don't worry if you can't come up with 20%. Another great idea is to check your credit report and your credit score. You're going to want to do that at least 6 months out from when you're starting to think about purchasing, so that if you find issues, they can be fixed. Sometimes there are errors on your report and you can get the errors fixed. You might even be able to take specific actions to raise your score, which is going to help you with your interest rate and with some other expenses as well. So besides understanding your credit, thinking about down payment, another number you need to think about is your debt ratio. Debt ratio is your monthly debt payments divided by your gross monthly income. So think about your car payments, student loan payments. Do you have a motorcycle? What are your monthly loan payments added together and divided by your gross monthly income? That's your debt ratio. Includes your credit cards, if there's any kind of court mandated payment, okay? If your ratio is above 40%, it's going to be more challenging to get a mortgage. And so you may actually want to focus for several months on paying down some debt and to get that ratio lower. So that's something to research as you're looking at the financial side of this. Finally, it's know your budget. It's really important to know how much can you actually afford to spend each month on housing. Please be brutally honest. I don't know if you've heard of being house rich and cash poor. And that means you're paying so much for your home mortgage payment that you have no money left for fun or for enjoying life or for emergencies. So please be honest about your budget. Okay, those are all some things to be thinking about before you go too far down the I'm going to be a homeowner path. Besides the emotional side, looking at those preliminary numbers, you're also going to want to think about the entire cost of your monthly housing, because it includes a couple things. When you're a renter, you probably have renter's insurance and you have your rent payment. When you get a mortgage and have a home loan, there are a couple other numbers that get thrown into the mix. And we are going to talk in more depth about each of these things. But I just want to caution you that if you get started on Zillow or something, they're not going to include all these numbers. When they say your payment would be this, they're probably not including all of these numbers, and all of these numbers are important. So I also want to point out on this slide that although there's a lot of talk about how Colorado housing is very expensive, and if you're in a different part of the country and housing is also very expensive where you are, would you throw that into chat? What market are you in where housing is an issue as well as it is in Colorado? I do want to point out though that renting and owning can be financially very comparable depending on the property you buy and depending on how much rent is in the market you're in. So just don't be afraid to do some research and see if it might actually work for you. This slide compares the payment for a 2-bedroom apartment in Denver and a mortgage on a condo. All right, I hope you feel encouraged that homeownership is possible even in our high-priced market. And I promise you we will look more closely at the different parts of a monthly mortgage payment in a minute. Alexandra, no questions? We're doing okay?
We are doing okay so far.
All right.
Feel free to pop questions in as they come up. Or if you're in another part of the country that has as wild of a home market as we do, feel free to pop that in too. But otherwise, we'll keep trekking along. And I actually do have a couple questions and comments. Someone from LA, I imagine your home market is quite nuts.
Yeah.
Glad you're here tonight. And then the question is, do you look into price to rent ratio to determine when it's a good time to buy? Great.
I think there's a lot of consideration on when is a good time to buy, and I'm not sure that I would focus on any one aspect. There's too many factors. For instance, if it's a great time to buy, but you haven't been able to save any money for a down payment, or you think you're going to get a job offer in another state, some of the statistics might look great, but it's still not a good fit. So yeah, just a lot of factors. I'm not sure that I would look at any one issue if I was getting started. And Alexandra, we're ready for our second poll. So anytime.
I will launch this. And then it looks like we have someone in Santa Fe as well. So another wild housing market. All right, the poll, Washington. We have a lot of you.
Yeah.
I don't know if I find that exciting or want to say sorry, because navigating the housing market is nuts, but hopefully tonight will help.
So, yeah, I mean, the good news is people are buying homes all the time. It just is more interesting process right now than at some other times in history. So, all right, we are getting some good answers in. Thanks, everybody.
We'll give you about 20 more seconds. We have about 80% of you who have voted so far. There is no wrong answer. Well, there is a wrong answer, but we won't know that you're the one that submitted it. So
we're pretty easy going
on. There's no wrong answer. Let's go 10 more seconds. 5, 4, 3, 2, 1. Awesome. Couple last ones clicking in. Okay, we're gonna share these.
So the majority of you weren't sure what these acronyms are. That's why you're here. Great. We will talk through, I promise, every single one of those acronyms and what they mean. And yes, the majority of you have the answer right. It is the mortgage rate right now is still around 3%, historic low. Joel, you had looked up that number. What was Canvas mortgage rate for 30-year?
Soft rate is 3.125.
3.125. Again, I can't stress enough how low that is. You'll notice that back in 1980, when I bought my first house, it was right around 13%. So huge difference in your monthly payment. Trust me, when it's 13%. So we will talk more about what that means in the process of home buying. But thanks, Joel. And let's keep going. Get some of these terms out there. And don't forget to use chat. We're about to talk about all kinds of terminology. So when you get a loan in order to buy a home, it's called a mortgage. One of the reasons that home ownership is possible for so many people is that there are so many different kinds of mortgages for different borrowers and in different situations. So we're going to talk through some of the differences between these kinds of home loans. And the first one we're going to talk about is FHA. And I just want to point out these first three, FHA, VA, and USDA, are all government insured loans. So that's a group of loans that have some special characteristics, but each one of them is for a slightly different target group. They are designed to help make home ownership possible for specific people or in specific locations. FHA loans are designed for first-time buyers, people with a smaller down payment amount, or a lower credit score. FHA loans will require mortgage insurance to be included in the payment for as long as you have the loan. So that is a distinguishing feature of these FHA loans. VA loans are fabulous. They have amazing, attractive benefits, including lower closing costs, no down payment requirement, no mortgage insurance, lower credit scores are okay. They have low interest rates and extra safety standards. They are only available for veterans. Fabulous loan product, only for our veterans. USDA loans are only given for purchases in specific areas. They're targeting rural areas that may be slower to develop than a more urban setting. So this time they're not targeting people who are trying to buy, they're targeting a geographic area where people are trying to buy. So those are the first three kinds of loans that are options. Then we talk about a conventional mortgage. It's offered by a private lender, and it will have higher credit score expectations, but it can be more flexible than one of the government loans. So my husband and I bought a home with one of my kids, and that would not have been allowed under the FHA guidelines. We had to use a conventional mortgage to have that multiple ownership where some of the owners weren't living in the home. Conventional loans are where this 20% down idea comes into play, because you can avoid adding mortgage insurance to your monthly payment on a conventional loan by having a 20% down payment. So I'm going to say that again. You can avoid having mortgage insurance be part of your monthly payment by putting 20% down on a conventional mortgage. So, and the reason people talk about that is because mortgage insurance does add a couple $100 a month to the payment, but we have to balance this out with the fact that 20% down is a huge amount of money in today's market. So please don't be afraid of having mortgage insurance as part of your mortgage payment each month. It's not a crisis. Sure, it's part of the payment, but please don't let that thought stop you from moving forward with looking into home ownership. And so we'll talk more about this kind of thing coming up. I want to move to the jumbo loan. Jumbo mortgages are for loans that are big, higher dollar figures than most of the other loans in an area. And each amount that moves it into the category of being a jumbo loan is determined geographically. So across most of Colorado, the amount, if you're going to borrow more than $548,250, then it's a jumbo loan. Now in Denver, that amount is higher. In Boulder County, it's even higher. Every area of the country has a different number that when you borrow more than that number, that's a jumbo loan. So you can find that, just Google jumbo loans in jumbo loan amount and your area, you'll be able to find out what is the break point where it's considered a jumbo loan. So what's the big deal with that? It may require a higher down payment. It may require that you prove that you have some savings set aside. There may be a little extra paperwork because of the high dollar figure that's being loaned. Okay, nothing to be afraid of. Just it's a break point at a certain number determined by the geography of where the house you're buying. And then I want to stress that over the years, mortgage lenders have done some very creative things to help people get into home ownership. When we bought our house back when interest rates were 13%, we actually got into a graduated payment where for the first year our payment was one amount, and the next year our payment went up, and the year after that our payment went higher. But so we started low and built up to a higher monthly mortgage payment. Sometimes people use a second mortgage at the same time as their first mortgage as a way to make the loan happen. And there are first-time buyer home programs. And I just want to mention one that Canvas does, which is 100% home. It means you don't need a down payment. So all of these things are possible. All of these things require that you work with a lender that you can talk to, and they can explain things to you and say, you know, I think based on where you're looking, we should look at a USDA loan. Or, ooh, have you thought that this is going to be a jumbo loan? There's just so many reasons to find a trusted mortgage lender who understands all these different programs, and the fact that all these things exist to help people find the right product for their mortgage. Lots of different options out there.
And a couple questions for you, Nancy.
Sure.
So the first one is in relation to jumbo loans. And it says, I think I heard somewhere that jumbo loan limits vary depending on how many units the building has. Is that true? For example, if you bought in a quadruplex versus a single family home.
If you're talking about more than we're talking about some commercial lending. Joel, pipe in if I'm getting this off base in any way, but if you're buying more than a fourplex, this is investment kind of thing. This is not a home ownership traditional mortgage situation.
That is correct. We have a limit of 4 units. Anything above that is considered as commercial. So that would be a limitation. And the limit is depending on what you would qualify for. For Canvas, I think we have about 2 to 3 mil, and we can go above that, and it's just a matter of getting it approved.
Awesome.
Yeah, if we're talking above a single family home, we start to get into some specialized lending questions.
Awesome. Thank you both. And hopefully that answers your question, but feel free to throw follow up in the chat. The second question is, can you refinance an FHA into a conventional loan?
Yes, as long as you qualify for that conventional loan. So again, remember there were some lower credit options that helped you get into an FHA loan. So you need to be sure if you're switching over to conventional that you still qualify. So yes, but absolutely. As long as as long as we can check all the boxes. Yep.
And Nancy, would the only reason to do that be to get rid of that mortgage insurance?
Yeah, or if for some reason interest rates had changed a lot. I mean, people refinance for a variety of reasons. We do have a slide about refinancing and some considerations there. Again, it's often not a single thing that people consider. They have to look at a couple different things before they say, yeah, I want to refinance.
Perfect. Great questions. And then our last question currently, is there PMI with 100% home from Canvas? And for those on the webinar who don't know what PMI is, will you explain that as well?
So that's the mortgage insurance. Joel, can you answer if mortgage insurance is required as part of the 100% home loan?
Yes, it is. And you still have to qualify for it just like any other program. And just a quick answer, yes.
Okay, awesome. Thank you. Again, tons of different kinds of mortgages, trying to fit in where do you fit, where's the right answer for your particular situation. So awesome. Keep the questions coming. Yes, another one?
Still coming. I have one more. Another one just rolled in. Can they do a first-time home buyers with an RHS in a rural area? And will you let folks know the RHS acronym again?
Oh, that's that rural housing. It's the other term for the USDA loan. You know, first-time home buyer programs vary also by geography, by the county, the city. They're offered up by different organizations. We'll have a website at the end where you can check for specific first-time home buyer programs. But even that, the website I have is for Colorado. First-time home buyer programs vary tremendously by location, and they change over time as situations change. So you would have to do research in your own local area to see what the first-time homebuyer options are.
Awesome. Really great questions all. Thanks, and continue to utilize the chat, but we'll keep trekking along for now.
Okay, so we're going to talk about some terms as in time of length, and then we're going to talk about some terminology. So the term, the length of the loan comes in a variety of sizes, different options. Some common lengths are listed there. For most people, especially as you're getting started, they're going to choose a 30-year loan. And it's simply because the dollar figures for the home purchase are so high, we extend the payments out for 30 years. Otherwise, we can't afford to make the monthly payment. There's an example there of if you had a $300,000 loan and the monthly payment at a 30-year term and the monthly payment at a 15-year term, you'll see it's $800 difference. Most people can't absorb that kind of difference on their monthly payment, so they go with the longer term loan. Okay, and then let's switch out from how long a loan lasts to all those acronyms that we promised we would talk about. So loan to value, LTV, loan to value, is a ratio that compares how much you borrow divided by how much the home is worth. And lower is better. So let's think about that. If your home is worth $300,000 and you borrow $200,000, 200 over 300 ends up 66% loan to value. Lender feels pretty good giving you a loan for $200 on a $300,000 property. If your loan is $299,000 on a $300,000 valued home, your loan to value is 99%. A lender is less comfortable loaning almost the entire value of the home to you. So loan to value, you'll have an easier time getting approved for a loan if you're not borrowing the full amount of the value of the home. Okay. DTI is debt to income. It's another ratio we like to see low. We already talked a little bit about this and said that you should try to be below 40%. Again, debt to income is the total of your debts on a monthly payment basis. So add up your monthly payments on your debts and divide that by your gross monthly income. Again, a lender is more comfortable giving you a mortgage if your monthly payment isn't going to be so high that it feels like it's putting your other loan obligations at risk. Okay, so we want to be smart about making sure you can meet all the obligations you have. TI is principal, interest, taxes, and insurance. And that is the different parts that make up your mortgage payment. Now, you probably thought, yes, I got a loan, so I have to pay back the principal of the loan, the main part, and I have to pay interest on my loan. But a lot of people aren't aware that you are expected to pay 1/12 of your property taxes and 1/12 of your homeowner's insurance with every monthly payment. And the reason those amounts are collected in a monthly payment instead of waiting until they come due is that they're big enough that it can be difficult for a homeowner to come up with the full amount if you're just paying annually. So if your property taxes are $2,500 and you haven't been planning for that, that can be awkward. Same with that larger insurance payment. So lenders figured out, you know what, we'll just collect a little bit of it every month and then we'll pay the bill. When you make your mortgage payment and you send that money into the lender, they are taking 1/12 of your property tax and 1/12 of your homeowner's insurance, setting it aside in an escrow account. And they keep it there until the bill comes due and then they pay it. So you don't pay your property taxes yourself. It's collected by the lender in little bits. When the bill comes, they pay it. Same with your homeowner's insurance. So PITI means that the principal on the loan, the interest payment on the loan, 1/12 of your annual taxes, and 1/12 of your annual homeowner's insurance are collected each month. Let's talk, oh, and then that escrow account, as that is sitting there and collecting those payments before it gets paid out, by law, a lender can't collect too much. So if for some reason they've collected too much, they will refund you. If costs go up, which is pretty common, property taxes have been going up consistently, at least in Colorado recently. And so if they need to have more, then once a year, they will adjust that payment. They'll send you a letter and say, hey, this is our situation. Do you want to pay it all at once? Do you want to have your monthly payment go up a little bit? How do you want to handle the fact that we don't have enough money set aside? So every year that gets reevaluated. But that escrow account, they can't keep too much. They will have to return it to you if for some reason it builds too big. All right, we're at PMI and MIP. They're the same thing. It's that mortgage insurance. Private mortgage insurance or mortgage insurance premium. It's a protection, an insurance protection for the lender. What it does is set aside money that you pay every month in your mortgage payment. And it's an insurance that if you don't pay, the lender is protected, has an insurance product to protect them from you not paying. So if you think about your homeowner's insurance, like we talked about in PITI, that homeowner's insurance, that's for things like fire and hail and your neighbor kid breaking their arm on the tramp. But mortgage insurance protects the lender if you don't pay your mortgage, okay? There's a couple other terms that get tossed around you may have heard of. One is points. It is possible to pay extra upfront when you're getting your loan and lower your interest rate. That's called paying points. Joel mentioned that the rate was just over 3%. If you wanted to pay points, you might be able to get that interest rate below 3%. So this is a personal decision. It's based on what's going on in your life, what kind of home you're buying, what kind of interest rate you qualified for. Why would you do it? Why would you not do it? Personal decisions, lots of economic considerations, but some people choose to pay points and go into the mortgage at a lower rate. And then the other thing is fees, and it's a big topic. When you get a mortgage, there are fees. There's a bunch of them, and they are paid different ways. Some of the fees are paid by the seller. Some are paid by the buyer. Some take place really early in the process. Some you can get back. Some of them get paid at closing. Some of the fees can be put into the loan, so it's part of your loan payment instead of needing cash at closing. So a lot of variables on the kinds of fees that are out there, but when you work with a mortgage lender, they're going to explain them, explain which ones are doing what, which ones you'll have to pay for, which ones are negotiable, what's being covered by the seller. All of those kinds of things will be explained by your mortgage lender. Okay, a lot of stuff. Got some questions?
You know it's coming. Let's start with, does DTI include student loan payments?
Yes, indeedy.
Awesome. And I'm going to put a shameless plug for the Alumni Association in here. Our next Young Alumni series is on student loans. So if that's a topic that you could use help addressing, we'll be doing that on August 10th, and I'll pop a registration link in the chat here in a minute. Next question is, when you pay property taxes monthly with the loan, does it matter if your loan is with a private group or out of state?
No, it won't matter. It's the lender's duty to collect that and to pay it. And yep, the lender can be located anywhere.
Great questions all. And then the last one we have for now is, does a point equal 1% lower?
Joel, I'll let you handle that one.
No. Okay, let me tell you what that means. Okay, For the sake of numbers that you were looking at, let's say you're borrowing 300,000 and you want to buy a point. What that means is you're paying $3,000 to have a 0.125% reduced. So for a 0.25% reduction, that's going to cost you 2 points. So that means to get a 0.25% off, current rate right now is 3.125. To remove that 0.125, that means you have to pay 1%, which is $3,000 to bring down the rate to 3%. And if you want a 0.25%, so to be able to bring the rate down to 2.875, that means you have to pay 2 points, which is $6,000. So the answer to that is no, it's not really a percentage of a full percentage of a rate, but rather the points you're paying based on the loan amount.
Which is why I have Joel here, as opposed to Nancy trying to blunder her way through that. Thank you.
Great questions, and I know there are a lot of intricacies, so if you need follow-up to any of these answers too, please continue to pop them in the chat. We're just going to keep going down the list because we have quite a lot of questions rolling in. So will you just confirm PMI is not required if you have 20% down?
PMI is not required if you have 20% down on a conventional mortgage. If you are getting an FHA mortgage, you will pay private mortgage insurance, or the other one, the mortgage insurance premium, for as long as you have that loan. You could have 50% equity and you will still be paying mortgage insurance if you have that FHA loan.
Perfect. And then the next question is actually quite similar. You answered, I think, half of it, but how much value do you need to avoid PMI, which you just answered, or extra fees? Is there a certain value to avoid those extra fees?
It's going to depend on the lending product. There's so many options and things. It is really important to compare. It's an interesting industry in that if they chop off a fee here, maybe they've raised a fee over there. Is the interest rate great, but the fee structure is bad? I don't know if you want to weigh in, Joel, on how you evaluate the fact that this is, it's not just like you look at ABC and you're done.
That is true. So are you answering that what loan to value ratio makes sense? Is that what we're answering?
I think it was like how to avoid some fees.
How to avoid some fees in regards to MI? What fees are we? I'm sorry, I got confused with your question. Sorry.
No worries. So the exact question is, how much value do you need to avoid PMI or extra fees?
Okay. Well, 80% on a purchase, basically you got to put 20% down. Now to have that removed, I believe that's what I'm kind of leaning on. Usually they want at least 80% on equity on a conventional loan. So sometimes they feel more comfortable about 78% they have to remove it. But technically 80% is a safe bet to have that thing removed. On an FHA, like Nancy mentioned, it's a lifetime commitment on that loan. And then there are lenders where you want to watch what you're signing because even though you have a 80% loan to value, but you only been in a proper loan for about 6 months or less than a year, some of the contract they wanted maybe a year or two before you get out of that MI. So you just kind of watch the contract that you're signing, depending on which lenders you're going to go into.
Awesome, thank you, and great life advice just to read all contracts all the time. Okay, I've heard you can pull from a 401k for down payment as a first-time home buyer. Is that true?
To the best of my knowledge, yes, it is.
Perfect. These are great questions. We are just trekking through. The next one is, does the lender collect interest on the funds in the escrow account? I know in some states it's illegal to collect interest on money held in escrow, or the interest earned has to be returned to the customer.
I am not aware of anyone who would collect interest. No, it's a holding fund and then the funds go out.
And then the last question we have for the moment, although certainly feel free to continue to send them in, is what LTV ratio makes lenders more comfortable?
That's going to depend on some other factors as well. LTV is one of the things that a lender will look at. If you have an absolutely fabulous credit score, high income, great savings, they may let you go a little higher on the loan to value. If you have a low credit score, limited credit history, you're not putting much money down. Now, all of those things put together. So again, I'll have Joel weigh in if he wants to add to that, but I think it's not just here's the magic number. They look at the entire package of information.
Actually, the question should have been the other way around. What LTV are you comfortable with, rather than the lender? Because what we do, we just qualify you for whatever your comfort level is. Also, keep in mind the MI, the PMI, basically depending on how high the loan to value is. Some people want to put 10%, so that way they pay less on the PMI. Some people feel comfortable, hey, I have say 5%, so which is okay too. So it's not really what the lender is comfortable with. It's more like, what are you comfortable with? And then we begin with that.
Awesome. Again, I can't stress enough working with a mortgage lender who can explain and help you through this, because there are so many variables, obviously.
And we still have more rolling in, which is awesome. We love the questions. Can you avoid a mortgage altogether if you can pay cash for a home?
Yes.
Perfect. Does the Canvas 100 home mean the LTV is always 100%?
Joel?
Yes, that's exactly what it is. Purchase price, for the sake sake of example, is 300,000, and we are willing to finance 300,000 of that loan amount. We can also add on some of the closing costs if you want to. You have that option. It's just a matter of qualifying based on the debt to income ratio, based on your FICO score. Those are the key factors. But so the answer is yes, we will finance the full purchase price of it. Or paraphrase that statement, there's one little factor there. Also, based on the appraisal, we want to make sure that if the appraised value is you're buying it for 300,000, the appraised value is, let's say, 280 for the sake of our conversation here. So that means we're going to finance whichever one is lower. And so then you go back to the negotiating table if it comes down lower. So that's pretty much how we do it.
And we will cover some of that kind of information when we get to the section about working with a realtor. So if your questions are related to anything about that kind of process, hang on, we're getting there.
And we have a couple more questions, but I will also say, because I know this is a lot of information, we are going to include a recording of this, a bunch of resources when we send out the recording. And if you have follow-up questions, feel free to email the Alumni Association, and I'm happy to connect you with Joel and Nancy for further conversation around some of these loans and whatnot. Joel, this may be another question for you. Back to the previous conversation, how much DTI is normal for a person to be comfortable with? Is there a typical amount?
Well, usually, like Nancy mentioned, 40% is a very good indicator. We could go up to about 42%, 43%. I mean, I was kind of stretching that out a little bit, but normally depends on what cash do you have. I mean, you can have a 40% DTI with a $3,000 extra money, so that would be good. So it depends on the cash flow. So those are the two factors, not only the DTI, but also the actual cash that you have available. So but from the lending standpoint, what's the approval ratio? About 40%, 42%. We could do about 43, even a little higher depending on the type of down payment you're putting down.
Awesome. And then this one, we're actually switching tracks a little bit, but it is what is considered a fabulous credit score. Is there much difference once you are above 750, or at that point, does it matter? Also seen a 720 threshold mentioned.
Okay, so some of these loan types are going to allow for lending at a particular credit score break point, and some others are going to be the interest rate will change at particular break points. All of that changes given what's going on in the economic world, and it varies lender to lender. However, in general, yeah, if you're in the 740 and above range, you're doing fine. You're going to get some great offers and rates and approvals. A very healthy place to be, no problem. So yeah, but it has the potential to vary depending on what's going on in the economic cycle and depending on what a lender individually is comfortable with. So Alexandra, I'm gonna put us on hold for questions and keep going. I don't know if we got caught up. Are we close?
We have one more. Let's do last one. It's related.
Okay, sure. One more.
Is there a FICO score credit for that 100% home?
Oh, good question.
Yes, 700.
Awesome. We are caught up. Go
Okay.
team. We are rocking and rolling. One last small plug. We do also have a recording of a previous webinar with Canvas Credit Union on credit scores. So if that's a resource you need, I will pop that in the chat too. But let's keep rolling on home buying. I know we promised to wrap up by 7 tonight, so we got to keep trekking along.
Here's that review of all the different parts of your mortgage payment. So again, sometimes if you're looking on Zillow and it says your mortgage payment would be this, dig a little deeper, see if it includes all of these things. So your principal, you're paying back the loan amount, you're paying back the interest that you owe on the loan, you're paying back 1/12 of your taxes, 1/12 of your homeowner's insurance, and then if there is a mortgage insurance as well. All of those things go into the monthly mortgage payment that you send to your lender. Now, obviously, you still have to pay utilities. There may be an HOA fee. So there are other payments that go with the fact that you have this home, but they are not part of the mortgage payment. These are the pieces that go together to add up to your monthly mortgage payment that you're going to send away. Okay. I don't know that we had a lot of people interested in refinancing. I'm actually going to put this in the parking lot. We do have some things about refinancing. If you want to come back to this topic, please put it in chat. We will circle back when we're done to the topic of refinancing. But the vast majority of our attendees tonight were interested in this first time process. So let's talk about working with a realtor. So again, if you want to talk refinancing, please put it in chat and we will go back to talking about refinance. The process of home buying obviously can be complicated. You just learned about all the options related to lending, and the process of actually finding a property to purchase can be confusing as well. So just like your mortgage lender is going to help you through the process of finding the right loan, your real estate agent, your realtor will help you through the process of finding the right home and negotiating that purchase. So they know about neighborhoods. They know about what's going on in the market. They know about the documents. Oh my goodness, there are so many documents. The process. They just really understand this in a way that it's become so complex. It's really challenging to buy without using a professional to help you. So there's a couple different ways to use a realtor. Be sure you're understanding what they are doing for you. It's critically important that they represent you, your best interest. It can be tricky sometimes if they're simultaneously representing a seller. So just read your documents, understand the difference between having them represent you, okay, in this purchase. It is one advantage when you are the buyer. It is the seller who pays the realtor fee. So that's one fee that you don't have to cover. Keep in mind as you're looking for a realtor, some of them specialize in a particular market area or a particular price point. They only deal in $1 million homes. They only deal in first-time home buyers. They only deal in condos. So there are lots and lots and lots and lots of realtors with lots of different styles. Please talk to your friends, somebody who just went through this and they say, yeah, I had a great experience. I would really recommend this person or something else. You can interview a realtor. You don't have to sign documents with the first one you talk to. Get comfortable, ask some questions. How many homes do they sell each year? How long have they been in business? Is this their full-time job? Do they have references? So some really important questions to ask, because the market is so tight. To have a really strong working relationship with your realtor is critical. So I know it's really nice that your cousin just got into real estate and is trying to get on their feet and make their first big sale. But you really need some expert help at this point. This is a big dollar project. It can be stressful. Please be very wise about your choice of realtor. All right, I was watching chat light up. Holy smokes, what do we have now?
We've got a lot of folks interested in refinancing, so we will loop back around on that. And then a couple of comments about how to know if you can trust a realtor. It feels like their incentive is always a little skewed since they make a cut of what they're selling. I don't know if you have anything additional to add there, Nancy. I would just say I think it is great advice to talk to others who have had really good experiences with their realtors.
Yeah, and I would again go back to that. How many homes do you sell in a year? So I know it's a really tight market right now. And so honestly, some really fabulous realtors aren't selling much right now because there isn't anything to sell, which we'll get to in just a minute. But if they're selling 1 or 2 homes a year, they may not have the experience you need. So ask some tough questions.
And then just a terminology question, but I think it's a good one. Are a realtor and a real estate agent the same thing?
So a realtor has been accredited and has the little copyright symbol, but that's not copyright, but you know what I mean? Yeah, I think you will find that almost everyone in the business is a realtor. But Joel, do you have any insight on that?
Well, realtor and not really. All I know, they're pretty much the same. Real estate agent and realtor, I think it's more like where they work for, or let's say a real estate office would be like, say, Keller Williams, the name of that, and then people who work under that. So the realtor is really like Keller Williams in a sense, and then the real estate agent would be the people who work for that. That would be my shortest explanation of it. I don't know the whole technicalities.
If you see that someone is a realtor, it does mean they have had, they can't use that term without having some specialized training.
And then another question, you mentioned that 1 or 2 houses is low, but is there a red flag for a high end? Like if they're selling 20 a year, any red flags?
No, it's going to depend on the market. Again, I have a number of friends who are realtors, and it's just so slow right now. They're not on pace, whereas last year they were selling like crazy. So, yeah, I don't know that you can sell too many homes a year. At least the realtors don't think they can.
As long as they're making time to discuss your needs, I would say you're good to go. And I also just want to acknowledge we do have a lot of questions about refi stuff in the chat. When we get to that point, I will loop back around on those questions. So I'm not ignoring you, but also want to be aware of time.
All right, we will circle back to that as soon as we get through the market here. Poll time. Do we have a chance to launch that last one? We have one more poll for you to do some voting on.
This is an easy one, so you have 30 seconds. And by easy, I meant easy to answer quickly, not an easy answer. So if you worry about that.
Because we are all over the place.
I was going to say, I'll admit, I don't know either. So take your best guess. Yeah, it came out of my mouth and I was like, oh, that's not exactly what I meant. We have about 75% of people voted. Let's give you 5 more seconds. 4, 3, 2, 1. All right. Yeah, almost 50-50.
Almost 50-50. It actually is false. So a balanced market is considered about 6 months of inventory, which means that every house that's on the market right now at this moment would be sold in about 6 months. If it's shorter than that, like we're in right now, at like a 1 or 2 month supply, then it's a seller's market. And if it goes longer than that 6 month period, then it's considered a buyer's market. There's some other things we'll talk about that also factor into what's considered a buyer's or seller's market. But that inventory piece is one of them. And how long does homes stay on the market before everything gets sold? So yeah, let's talk about conditions in our market here in Colorado, true across the country in many markets. So again, do your research in your own market about who's got the advantage. Is it the buyers or the sellers where you live? You know, with the pandemic, you might have thought that home prices would drop or that people wouldn't buy. In fact, prices increased. There's a huge interest in buying, particularly in the lower price points of the market, but there is extremely limited inventory. So we're going to pull up some real numbers here to bring this to life. Obviously, real estate purchases and markets vary tremendously by location. So depending on where you live and what kind of house or condo or ranch you're considering buying, the specific numbers are different, but here are some general things going on across the Colorado Front Range today. Location really impacts price. So you can see all those different, this is median sales price. Median is the one where half the homes are above the price and half the homes are below. Median price in May this year varies across just the Front Range from 370 to more than $1 million. You'll notice Greeley and Boulder, they're 50 miles apart. Almost $1 million difference in median price. Okay. I didn't throw up Loveland. It's similar to Fort Collins. You'll notice the Denver market's just a little pricier than the Northern Colorado, but and you'll notice the national price point. So just varies by location for sure. Okay, and then it varies neighborhood to neighborhood, but prices have been up year over year for the last couple of years, a lot. And then you throw in the challenge of the inventory is low. People are hanging on to their homes. They're not selling. During the pandemic, we discovered we're working from home. I still am. There was those who were in a home were seeing tremendous increases in the value of their home, and they really liked being able to be home. And so there just isn't much for sale out there. And again, that balance number is 6 months. We have a 1 to 2 month supply. So homes are selling very quickly. The last number I saw for the Denver market was that homes were selling in 5 days. Depending on the price point, if you're selling a $5 million property, it's not going to move quite as quick. But if you're in that lower price point in these markets, there are going to be multiple offers. Offers are coming in above the list price. People are waiving things, inspection, things they really shouldn't be doing. All of these things are indicators of a seller's market. The seller has the most power in this transaction. And again, the saving grace for our market situation has been these unbelievably low rates. So 10 years ago, the interest rate was higher. 20 years ago, it was much higher. Like I said, when I bought my house, it was 13%. So these are just historically low rates. It is making it possible for people to still buy a home, even though the homes themselves have increased in price.
I think this is a great question. I think it's probably the question on many people's minds, and I'm not sure you'll have an answer, but do we expect a buyer's market in Colorado anytime in the future?
The real estate professionals I talk to do not consider this to be a bubble. They consider it to be an ongoing trend, at least for a while. Nobody's got a crystal ball. Obviously, the pandemic came out of nowhere. And you would have thought it would have done some things to the market that it did not do. So no crystal balls. Please don't call me up and say you were wrong. But the general impression and everything I can find from any of the real estate professionals is they do not see this market changing anytime soon.
And in my experience, Nancy, you are rarely wrong. So related to that though, is it better to buy an older townhouse or a newer condo? I know folks often talk about these new build communities. Is there factors they should take in around typical annual maintenance costs for older versus newer?
You know, I would talk to your realtor about the reputation of the property you're considering. They are going to be very aware of if a development has had issues. They're going to be aware of if there were bad soils in that area and all the homeowners have had a complaint. They're going to be aware of the fact that that condo development is almost all rentals. Nobody owns their home and lives there. Just your realtor is going to be a real fount of information about particular niches. Townhome versus condo, a lot of that is, do you want one shared wall or do you want 3 shared walls? There's, and what's available. I don't know, in Colorado, I don't know if you know, there was some, they stopped building condos a while ago because there were lawsuits, and they've tried legislatively to fix this situation recently, but you'll notice there just isn't a lot of condo construction. There's some townhome construction, there's apartment construction, but there really still isn't much in the way of new condo development. Joel, again, pipe in if I'm wrong, but this is my impression. We're building single family dwellings, we're building apartment buildings, and we're building like townhomes or attached dwellings, but they're not what we think of as a condo unit. And so there's just limited inventory in that particular type of purchase.
You're right on the money, Nancy. I don't have anything to add. You hit it right on the nail.
All right, next tough question.
Okay, this is an interesting one. This person's actually living in the Phoenix market, but I think it would apply here as well. They're worried that they'll buy something and then it'll lose value down the road. Also, it's hard to find homes that are valued more than the loan. Will a lender be more hesitant to lend to them?
Okay, so a couple questions. One of them is going to be if your appraised value, and we'll talk about that in a second, but your appraised value is 300 and you're asking for a loan for 320, not going to happen. You're going to have to come up with that $20,000 so that your loan is in line with the appraised value. Okay, your home could lose value, you betcha. I told you that I bought at 13%. I think our loan was a mere 11%, something like that. We bought high, we sold low in desperation, trying to get 3 children out of a 2-bedroom home. By the same token, we had a place to live, we built our credit, it was ours. We didn't make any money on that. We barely got out by the skin of our teeth. But we built credit, we had a place to live, it was ours. Now, it would absolutely be a danger if we had to leave that property and would not have been able to ride it out until we could sell. I have, back in the last downturn, I go back that far. In the last downturn, people were very concerned. They were in precisely that same situation. They had bought high, values dropped, they had not put money down, and they were underwater, they were upside down, whatever you want to call it, and it was very uncomfortable. Your choice is ride it out, bail, or don't get into it. And those are personal choices. That's just the way the market works. No guarantees, no promises. Just know you're not alone. Other people have been there.
It really is a giant gamble. We're caught up on the current housing questions. We still have refi ones, but I'm going to let you keep trekking.
All right, so let's talk about what happens. You actually have found a lender you like. You're pre-approved. You must get pre-approved. You must give all the information about you to your lender, and they will say, yes, we will lend to you. And so all of that is done. You're pre-approved. You go with your realtor and find some homes to look at. You can do your own research. There's a website there to look at. Please don't trust Zillow. Please don't trust some other sites. They are not updated regularly. This is the website in our area where you want to look at properties. I just tipped off a realtor friend that my daughter's house is going to be on the market next week. So sometimes realtors know about things before they hit the system. Another reason to work with a realtor. So just work with your realtor, do your own research, but you'll be out looking for things that are available to purchase. When you go and look and then you go back and meet with your realtor and you say, yes, let's put in an offer on this house. You craft the offer. They will help you with the wording and the documents, and you offer to buy that home. Meanwhile, other people are offering to buy that home. So the owner then chooses who they will sell to based on the offers they're receiving. And if you are the one chosen, woohoo, we get to move on to the next step. Yes, I had a friend, I had a colleague who got the first, it was a tight housing market. She got the first house they bid on. Okay, but it's pretty darn common that you're going to repeat this process several times.
And
so
no,
until you're the one chosen.
Knowing that you have to repeat it several times often, how long do pre-approvals usually last for?
Joel, I think it's a couple months.
No, usually that's about 4 months. But then we just have to redo it again if it needs more time than that. Typically 3 months is a good indicator, but up the 4th month we can extend it, and we will work with you. And then if you need more time than that, then we just need an updated information.
Yeah, so the lender's just going to be looking to be sure your job hasn't changed, you haven't taken on a new car loan, something's really changed from what you were approved for. Great question, though. So repeat as necessary. You keep making these offers. Again, just that pre-approval to have in place at the beginning is absolutely critical. No realtor is going to work with you. No realtor is going to take you out until you have the pre-approval about lending. And then once you're the one picked, when it's like, yes, you are the one, we want you to buy our house. Now things really start moving fast. You have about 45 days to go through all these steps. You are going to pay, as a buyer, you're going to pay for a home inspection. People sometimes are waiving that now in an effort to rush through the process. We can't, it's highly, highly recommended that you do a home inspection. If you do an inspection, then you'll get a report, and you and your realtor can work with the seller to say, this must be fixed, it's a safety issue. Or, yeah, I don't care about that, let it slide. Your realtor will help you know what you need to negotiate on. You can walk away if the inspection comes back poorly. We put in a bid on a home. The seller wouldn't let the inspector up on the roof. Huge red flag. We said, no, thank you. We don't want that home. Okay, so strongly suggested that you do a home inspection. It will come out of your pocket. You won't get that money back, but it will, in all likelihood, give you a great deal of peace of mind, as well as tell your realtor what things you need to negotiate before you have that final contract. While you're doing those steps, the lender is ordering up title work to be sure that you can transfer title. They're going to order the appraisal. This appraisal protects the lender. This is to be sure the lender is not giving you more money than the home is worth. And this is an issue in our market because people are willing to pay more than the home is coming in appraised at, but a lender will not lend more than the home is appraised at. So this can be a sticking point and a challenge. Somebody mentioned cash purchases. This is where a cash purchase would triumph over lending because there's no need to make the loan. There is no loan. Doesn't have to make sense. Okay. It is very important while you are going through these steps, once you've got a contract, that you not open new loans, don't rack up your credit card debt, not the time to buy a new car. So your credit report will be examined again before you do the closing, and they'll be looking for anything that has really changed from what the situation was before when you were approved. So then homeowner's insurance, you must have your homeowner's insurance in place. And then you pack up your house, your old house or your apartment and move in. Oh, you do have to sign a lot of papers. A lot of papers you're going to be signing.
And then hopefully have a wonderful housewarming party.
Yeah.
In line with all of those papers and the world we're currently living in, I think this is an interesting question. It's what home buying interactions need and should be done in person versus which of these can be done electronically.
I'm going to suggest that you talk with your realtor about what would happen. I think it's very difficult to tour a home without actually touring it. People buy on video. That's your comfort level. Mortgage lending can be done virtually in most cases because you're just electronically submitting all your documents. It's more a matter of comfort level with your people, I think.
And I'm just going to keep ringing them off because we have a bunch of good ones in here. What is the advantage of cash offer over pre-approval and down payment? Anything besides higher likelihood of getting the house, walking away with the house?
If that's what you want to do with your cash, then that's great. If you had the opportunity to earn 5% on your cash, just saying, maybe in some world, I don't know, if you could earn 5% on your cash and only pay 3% on your loan, then there might be a valid reason. Those are personal decisions based on what all you have going on in your life. Can you spare all of that cash? So several things to consider there. Okay.
Perfect. To clarify, do the terms of the pre-approval change if you get an extension or renew it after it expires? And then how will this affect your credit score?
If we don't need to pull your credit again, then it won't affect your credit score. And I think as long as you can provide documentation that everything has stayed the same, that there haven't been giant changes, then there really isn't any reason to change the terms. What they're looking for is, has there been a change from what you submitted before?
Perfect. And I know some of those were similar and lumped together a little bit, but I think we got through this section.
Okay, and then there's only a couple slides left. I'm gonna cruise through those and then we'll circle back to our refinance and then we will stay on until all the questions are done. So, you know, you think maybe you signed all the papers, got the keys and moved in and that's it. I do wanna stress that home ownership does not end with moving in. Okay, you now are responsible for some things. And so one of the advantages to being a homeowner might be related to your income taxes. So you can check with your CPA. We really want to stress that it will make your life much more enjoyable if you are saving for emergencies. Emergencies happen when you are a homeowner. It just happens, trust me. So there will be expenses you didn't think of or expect. Plus, there are going to be exciting projects that you want to tackle. And all of those take money. And having a slush fund set aside is really important to make your financial position strong. So a common recommendation is to set aside 1% of the purchase price each year. So if your purchase price was $300,000, you should be putting away $3,000 a year. That's about $250 a month. And if that seems challenging to you, remember that a new roof is over $6,000, a furnace is $3,000, a refrigerator $1,500, exterior paint job $5,000. So home ownership is not for the faint-hearted or unprepared. It is tremendously rewarding. It can be an incredible source of wealth for you financially, but it should not be entered into lightly. All right, we're gonna get some resources up here, and then we're gonna do all those refinance things, and then any final questions. So here are the things you should be thinking about as you go, should I be getting a house? I'd like to get a house. Check your credit report, check your credit score, see what's on there, make sure it's accurate, raise it if you can raise that credit score. Again, we have that video link that is about credit, how the credit scoring system works. You do that through annual credit report, and that website is listed there. If you look at your numbers, look at your budget, be very, very sure about what you're getting into. Can you really do this? Okay. Research your lenders. Obviously, I'm going to suggest that if you belong to a credit union, that you talk with the credit union about getting a mortgage. Please talk with friends and family for referrals to those real estate agents. I did put Joel's email on this slide. If you have questions that have come up that seem more complex or specialized and you really want the mortgage expert to answer them, you can reach out to Joel. Hollow Property was that website for doing your research about properties for sale. The HUD.gov site just has some general information about homeownership. And I promised a website that would talk about first-time homebuyer programs. That's the CHAFA site, Colorado Housing something something. And so that's where you can check for first-time homebuyer information in Colorado. Whoa.
Deep breath,
All right.
everyone. We're going to circle back to refinancing. We are going to get the questions that are currently in the chat answered, and I know we're sneaking up on 7, so I'm going to pop a survey in the chat too for those of you who aren't interested in refinancing or are going to hop off. Do feel free to fill out the survey. It lets us choose our next topics. Home buying was chosen because folks ahead of you filled it out, and it also lets us know if you want to connect further, have more questions, all of those things. But with that, I know there's still a handful of questions in the chat. I know we also have some refinance stuff to cover. So I'm going to let Nancy continue on, and then we'll get to those questions at the end. For those hopping off, thanks for sharing your Thursday night with us.
Yes, thank you so much. Okay, so a couple fundamental reasons why people choose to refinance. One is based on financial considerations, like you want to lower your monthly payment, or you're going to withdraw cash because you have equity now in your property. You own value in your property and you want to get that cash out and use it for something else. There could be another great reason, financially related, is that mortgage insurance thing. You had a conventional mortgage and now you've reached more than 20% equity, so you'd like to refinance and get rid of that monthly part of your monthly payment. The other reason besides financial is personal reasons such as a divorce. And a new loan must be created to reflect new ownership. So kind of those personal reasons and the financial reasons, those are the triggers for thinking about a refinance. So some of the other financial situations might be that loan rates dropped or your credit score got better. So just again, a variety of things influencing why you would choose to do a refinance. The critical decision maker, if it's not something that is a personal thing, like you are forced to do this because of a divorce and there will be a change in ownership, the financial evaluation tool about whether you should do this or not is, will you stay in the home long enough to recover the expenses that go with a refinance? There are fees associated with refinancing. So if you're only going to be in the home for 3 more months, the likelihood of you saving enough on your monthly payment to recover your fees is highly unlikely. If you're going to stay for 10 years and you're going to save a certain amount of money every month, chances are very good you will recover the costs that were associated with the refinance. So that is the big thing to consider is, are you going to stay in the home long enough to get your costs back from doing the refinance? Okay. And then the other things that you have to watch for a little bit are you still going to qualify? Did you get into this loan and things have changed and you know what, your credit score has dropped or your income has dropped and you in fact are going to have a hard time qualifying for a refinanced loan? Is there a second mortgage in place? That has to be considered as part of the process. You can't just get rid of the first if there's a second in place. And then that all critical important question, are you going to be there past the break-even point when you will have saved enough on your monthly payments to cover the expense of doing the refinance? So, any chance we knocked out any of the questions by having that conversation?
No, but they're good questions, so they're worthwhile. Can you have an interest-only loan on an FHA loan, or would you have to refinance an FHA to get an interest-only loan? Does that make sense to you?
Yeah, so I do not believe FHA offers an interest-only loan. I'm going to hope that Joel pipes up here.
Okay. No, I don't think they do. I agree with you. They don't offer that. And very selective lender will only do interest-only payments. Very, very selective. I mean, right now, I don't know anyone that's doing it, but I'm sure there's some out there that's doing interest-only payment.
So interest-only payments and loans were one of the reasons we had the financial crisis of 2008, 9, 10. And so again, just like Joel said, it's a very selective, very particular circumstance where you might want to get into an interest-only payment.
Perfect. And then this one's pretty specific, but it's, we are looking to rent our current condo and rolling a Canvas HELOC back into this loan. Are they better off doing this, hence reclassifying the condo as a rental and the mortgage, than going up to 4.99%, or doing the 100% home loan with PMI?
I'm going to go with too many variables. Can you afford this or that? Is there a particular reason you're thinking about hanging on, or yeah. Sorry. I'm going to go with too many variables and email Joel directly with all those specifics.
All right, this one says, I would like to buy a home soon, but not sure if or when that will happen. Is it worth refinancing now to a lower interest rate? Currently have almost 5% rate and owe under 40,000.
Do your numbers make the break-even point make sense? Will you be in your home, which you are refinancing, long enough to, on the monthly savings, get back your cost of doing the refi?
This one is, I think, one that I know a number of our young alumni find themselves in, but partner owns the home, beginning discussions on how to refinance with both people on the loan. Any tips, tricks, just knowing that that might be a common situation?
Sure. So I'm going to suggest that you're watching for, what are your goals? Is it to build credits? Is it to be sure you're both listed as owners? Is it to save money because rates have dropped? So a variety of factors, but you can be added as an owner on the home without being on the loan. So if your goal is simply to both be owners of the home, that's a deed issue as opposed to a loan issue. And then in looking, anytime you're going from one person to two people, now often that means that there's more money available, but does it mean that credit scores are lower? So the interest rate's going to go up because the second person has a lower credit score, the new person. By the way, when they do mortgage lending, they're going to look at all three of your credit scores from Experian, TransUnion, and Equifax, and they're likely going off, if there's two people on the loan, the lowest middle score. But so again, with adding a partner, that's a fabulous question. There are multiple reasons why you're doing that. Be sure you understand that you will achieve your goal in how you go about that.
Awesome. How about how much are all the other closing fees in general? It's hard enough to get 15 to 20%, but if the closing cost is another 5 to 10% of the purchase price, then it's difficult to gauge when you are ready to buy since you have to save for that as well.
Yeah. Boy, the last number I heard was, I think, in the 3% range of the price of the home. Joel, if you have a more accurate number on that, on closing, I mean, fees and closing.
Well, a lot of times, that when that question arises, we could speak of how much we charge. We charge $700. That's the canvas fee. And then the rest of them are pretty much third-party fees like appraisal, title, escrow, taxes, insurance. So that's why it's kind of hard to get specifics on it until you actually have a property in mind, because then we can identify the taxes. We can identify, what kind of insurance you need to pay. So those kind of things. And so, to put a number on there, I usually tell people, hey, save between 5 to around 10 grand for the closing costs. That puts you in a good position. But again, that's why it's such a huge variables on there. It depends on the, where you're buying the house, what's the taxes in that area. So those are the kind of things that plays a role in there. So I would say between 5 to 10 grand usually is safe. Now, if you're buying a jumbo loan or multi-million-dollar, then that changes the parameter altogether. So depending on the numbers, basically.
I don't think, though, that you need to worry about 10% of the purchase price. That's probably not going to happen. But like Joel said, there are a lot of variables. So.
And I think being here is a great first step as well, but I can definitely echo that it is intimidating. Does Canvas use a Vantage or FICO score for mortgages?
FICO scores.
Perfect. And then this one, I like that you labeled it unicorn question. When will the market change back to a buyer's market? We don't know. And then, yeah, it says any thoughts there. This person's guessing 6 years. I would invite others who are still on to pop in the chat your guess. I don't know if you have a guess, Nancy. I don't.
6 feels long, but I mean, the stock market went nutso for how long? And that's unprecedented. We've never seen that. I mean, a pandemic. Oh my gosh. So no crystal ball here. Real fuzzy. Sorry.
Definitely a unicorn question. Yeah, for folks watching, if you have estimates on when we're going to see a buyer's market, feel free to pop those in the chat, but lack of an answer on that one. I think we are all caught up. Oh, sorry, actually, related question. If you buy a home that needs a fair amount of repair to be able to bring it up to a livable standard, is it possible to get those costs lumped into the loan, or do you always have to pay for those out of pocket?
I'm going to take the liberty of answering this because we've had that question come up so often. Usually you can't plan on future repairs being part of the purchase price because it has to be based on the value of the home right now. There are some other specialty lenders where you might be able to do something like that, but as just a person buying a loan and it's a super fixer-upper, and getting a loan, buying a house, it's a super fixer-upper, and you want to include enough money to do the repairs, most normal lenders are not going to do that. But you are not the first person to ask that question.
Speaking of the issues of the market, how do you compete with large actors like BlackRock that are showing up, buying lots of single family homes and then turning them into rentals?
So a couple of things going on. The seller still has the right to sell to who they want to within some legal discrimination factors, but depending on the seller, they may say, you know what, I don't want to sell to some out-of-state investor who's going to turn it into a rental. I want to sell it to a family who's going to send their kids to grade school down the street. And if you can work with your realtor to tell your story, it is possible you will beat out some of those other actors.
And then this one's interesting as well. Is it worth buying land and then constructing the house? Do you generally save money that way? Also, how does the loan work in that case? Do you get the loan for the land and then the construction, or just the land?
Again, there are some real challenges with construction loans, and bridge loans are called, where you are getting a loan that will help you with the construction part and then it transitions into a mortgage. So those are tricky to find. And again, crystal ball, when do lumber prices drop? You know, so there are some special challenges that go with that. I will tell you that some people prefer to look at new construction instead of buying an existing home in this market, because they are just talking to the construction people about buying the house. They're not competing with 45 other people who are going to come in with, you know, $10,000 above purchase price and a Lamborghini on the side. I don't, you know. So sometimes people are looking at new construction as a way to avoid some of the intense competition. The problem with that is that there is very little new construction at a lower price point.
Awesome. The next question, we are winding down here, is are appraisers typically underappraising homes relative to the actual market value right now? And if so, is there anything we can do about that?
I am not aware of that issue. Appraisers are regulated, I believe. I mean, you have to be tested. Oh, Joel, help me out on this, or somebody who knows more about being an appraiser. I don't think they stay in business if they're taking unethical actions.
That is correct. It has to have comparables on it, so that's a key factor. And they in other words, nothing can be done intentionally wrong. I mean, I haven't said that, you know, appraisal is perfect, but there can't be a motive behind any of that appraisal. And then, so what happened is, if the question under appraising homes, so it's pretty straightforward. And then you can dispute it if you're not happy with it. But again, you don't just say, hey, I don't like it, so I'm disputing it. So you need to be able to produce comparables in order to justify your argument in a sense. So there is that opening there. So it can be challenged, but it's got to be challenged the right way. And if you don't agree about certain things, but for the most part, the appraiser are licensed and they're pretty fair about it. That's why, you know, us a lender, one of the ways that we don't have influence on the pricing is we have to hire a middleman, a management company, so that way they can hire the appraisal, so that they will do the appraising. So none of the loan officer have direct contact to the appraisal, so that way there's no influence on that at all. So that kind of practices make things a lot more ethical, a lot. It's more right. It's more fair.
Related to that, Joel, could a house be underappraised because the market is rising so fast?
I'm sorry. Something is making. Go ahead. Do that again, please.
Could a house be underappraised because the market is rising so fast? So I think they're wondering if like the house gets appraised and then between the time it's appraised to the time you actually close, the value goes up. Does that ever happen?
Yes, it does, because right now we're such in a fast-paced environment. And then everybody's overbidding, 20, 30, 40,000 above asking price. So that may happen. But at the same token, I would not say just give up, because that happens. You go back to the negotiating table or talk to the loan officer, because there are ways that we could work something out. It doesn't mean if it appraises lower, does not mean the deal is dead. Simply may talk to me or talk to a loan officer, and then we can work something out on how to overcome those obstacles if they still want the property.
Perfect. Thank you. And then tips or suggestions for exploring lenders to refinance. Is it similar to a realtor? Just ask around, talk to friends.
Of course, I'm going to suggest that you use Canvas, but you'll want to be sure you're comparing fees, comparing rates. Again, it helps to have been referred or somebody, yes, I used these guys and it was quick and easy. I don't know if any refinance is truly quick and easy, but yeah, the asking lots of questions, that's always good.
I would just echo that. Recommendations are always great. Well, friends, you all have had amazing questions. I think we've gotten through all of them in the chat. I do, Nancy, anything else you want to add before I close us down tonight?
No, I just, people are still buying houses. I told you that my daughter's house is going on the market. It still does happen. Yes, there's intense competition. Yes, it can be frustrating, but it is still happening. Again, know yourself, know what you're getting into. And Joel, I'm looking to you too. Is there any other closing comment, encouragement for our listeners?
Absolutely. The most common question is, when is it good to buy? That's always the question. And my answer is when you're able to. Reason for that is your home is a long-term investment. So it's not like a stock market goes up next week, goes down the next week. It is a long-term investment. You're going to live there for on average about 10 or even longer years. So that means you're going to be there for a long term. So that's why don't look at it, hey, today is up. Is it going to go down? Yes, it may. Would it go up? Yes, it may. That's the part that we do not know. But historically, real estate's been going up on a historical basis. If you look at it, 100 years from now or 100 years ago, you would look at, hey, it's still going up. So it's still a good investment based on statistics and history also. And so I would say, yes, it's always a good time. And that's why you prepare for it, because it's your biggest investment. And it's always going to be, there's a lot of benefits to it. Like some of the things that you mentioned, Nancy, the pride of home ownership, taxes, equity. There's just tons of benefits in doing that. And so that's pretty much my last word. And thank you, Nancy. I think you've done a tremendous job on this. Thank you, Alexandra, for monitoring this real well. And again, thank you for inviting me in this, I would say, this session.
Awesome. And then I will just close by thanking all of you. We really couldn't do this without you also. Thanks for giving us not only your time on a Thursday night, but an extra 15 minutes of your time. We will get the slides, resources, recording, all of that sent out. And please do feel free to reach out to any Nancy, Joel, or I with any additional questions. But with that, have a wonderful night. Stay cool wherever you are, and go Rams. Thanks all.
Good night, everybody.
Good night. Thank you.